Hi, everyone.
Let me show you something that should stop you in your tracks. 3 price explosions, 3 different decades, 3 completely different worlds, politically, economically, and technologically. And yet, before each one detonated, the exact same 4 structural conditions were sitting quietly in the background, like fuel waiting for a spark. Not 3 out of 4, not sometimes, all 4, every single time, across nearly 100 years of monetary history. And here's what should genuinely concern you, or excite you, depending on how you're positioned. Those same 4 conditions are present right now, more intensely than at any previous moment in the past century. I'm not going to give you a price target. I'm not going to tell you gold hits a specific number by a specific date. Anyone who does that is selling you a fantasy. What I am going to give you is something far more valuable. A framework for understanding why gold moves when it moves, what sets the stage, and why the stage today looks disturbingly familiar to anyone who has studied monetary history. Stay with me, because by the end of this, you will see the financial world through a completely different lens. Before we go into the 4 conditions, let me frame what we're actually looking at. In 1934, gold was revalued from roughly $20 to $35 an ounce overnight. In 1971, it broke free and ran from $35 to $850 by 1980. From 2008 through the following decade, it surged from around $700 to nearly $2,100. And from late 2022 until today, gold has exploded from about $1,650 to trading above $4,000 per ounce, with central banks and institutional analysts openly discussing whether $5,000 is the next serious technical target. These weren't random moves. They weren't driven by headlines or geopolitical flare-ups, although those provided the spark. They were driven by structure, and structure is something you can actually analyze. Let's get into the 4 conditions. Every major gold move in the past century has been preceded by a very specific fiscal situation, not just high debt. Governments carry high debt all the time. What matters is when the debt crosses a mathematical line beyond which honest repayment becomes impossible. When a government reaches that point, it faces a binary choice. It can default openly, which Western governments almost never do, because the political and financial consequences are catastrophic. Or it can default quietly, by printing money and letting inflation slowly eat away the real value of what it owes. They always choose the second path. Always. In 1934, Roosevelt signed Executive Order 6102, forcing Americans to hand over their gold at $20.67 an ounce. Then the government revalued gold to $35. That single stroke devalued the dollar by roughly 40% and transferred enormous wealth from savers to the state. In 1971, Vietnam War spending and Great Society programs had stretched the U.S. budget beyond anything tax revenue could support. Foreign central banks, led by France, started demanding actual gold for their dollars. Nixon slammed the gold window shut on August 15, 1971. The dollar lost roughly a third of its purchasing power over the next decade. In 2008, the debt crisis originated in the private sector, but the U.S. government absorbed it. The Federal Reserve created trillions of dollars through quantitative easing to buy distressed assets. The cost didn't vanish. It was quietly transferred to every dollar holder on the planet. And today, the U.S. national debt has now crossed $38 trillion. The annual deficit is running near $1.8 trillion. Interest payments on the debt have surged past $1.2 trillion per year, which is now larger than the entire U.S. defense budget. Let that land for a moment. America now spends more servicing old debt than it does defending itself. At current interest rates, the arithmetic simply does not work. There is no realistic path where growth or taxation closes this gap, which means the second path, currency debasement, becomes not a possibility but an inevitability. The first condition is not only present, it is more extreme than in 1971 or 2008. Every major gold move has also been preceded by a fundamental change in how money itself works. Not a small policy tweak, a structural rewrite of the contract between citizens and their currency. In 1934, private gold ownership was literally made illegal. In 1971, the dollar's final link to gold was severed. In 2008, quantitative easing was invented and normalized, giving central banks the unprecedented power to create money at scale to buy financial assets. Today, the rule changes are happening simultaneously across multiple fronts, which is exactly why most people miss them. The Genius Act, signed into law by President Trump on July 18, 2025, requires stable coin issuers to back their digital dollars with U.S. Treasuries and cash equivalents. Read that carefully. The United States has just engineered a massive new captive buyer for its own debt through the stablecoin industry, which already represents over $200 billion and is projected to reach multiple trillions within a few years. This is financial engineering at the sovereign level. The government is manufacturing demand for bonds that the traditional market may no longer absorb at acceptable interest rates. Meanwhile, the Federal Reserve cut rates again in October 2025, bringing the federal funds target to 3.75 to 4%, even as inflation remains sticky above 3%. This is the textbook signal that priorities have shifted. The Fed is no longer primarily fighting inflation. It is managing the cost of government debt service. That is a monumental shift, and almost nobody is talking about it plainly. The rules are being rewritten. The second condition is firmly in place. The third condition is the one most people feel, even if they can't articulate it. When governments choose inflation over default, the cost does not spread evenly. It lands hardest on savers, on retirees, on anyone holding cash or fixed income instruments. Real returns, meaning returns after inflation, turn negative. Your nominal balance grows, your purchasing power shrinks, and the loss is invisible on a daily basis, which is exactly what makes it so politically useful. After 1971, U.S. inflation peaked at over 14%. Anyone holding dollars in a savings account lost roughly half their real purchasing power during that decade. Gold delivered a nearly 25-fold return. After 2008, the Fed held rates near zero for nearly a decade, while real inflation quietly ran higher than official numbers suggested. Pension funds, retirees, and conservative savers were mathematically guaranteed to lose real wealth. Today, average U.S. savings account rates sit around 0.6%. Even the best high-yield accounts offer around 4%. Official inflation is running near 3%, but real-world inflation in housing, food, insurance, and healthcare is substantially higher. When you factor in taxes on the nominal interest you earn, real returns for most savers are already negative, and this is before the Fed's continued easing cycle fully plays out. The trajectory is clear. Savers are being asked to fund the government's debt problem whether they realize it or not. The third condition is present, and it is deepening. Now here is where the story becomes impossible to ignore. Central banks are not retail speculators. They are staffed by economists and analysts who study monetary history for a living. They manage reserves on horizons measured in decades. When central banks change their behavior regarding gold, it reflects a deep institutional judgment. Before 1971, European central banks quietly converted dollars to gold, seeing what was coming. After 2008, emerging market central banks became net buyers of gold for the first time in a generation. Today, something unprecedented is happening. Central banks bought over 1,000 tons of gold in 2022, again in 2023, and again in 2024. The World Gold Council's 2025 survey found that 95% of central banks expect global gold reserves to keep rising over the next 12 months, the highest reading since the survey began. 43% plan to increase their own reserves, also a record. China's central bank has been adding gold for 11 consecutive months. Poland has become one of the most aggressive buyers, adding over 90 tons in 2024 alone. India, Turkey, the Czech Republic, Kazakhstan, Singapore, and Brazil are all accumulating steadily. Why? Two reasons, openly acknowledged. First, the freezing of Russian foreign reserves in 2022 demonstrated that dollar-denominated assets are politically conditional. They can be frozen, seized, or blocked based on political decisions made in Washington. Every central bank on earth took notice. Second, long-term confidence in the dollar's purchasing power is eroding. Gold has no counterparty risk. It cannot be debased by a central bank decision. It cannot be frozen by a sanctions list. This is why gold crossed $3,000 per ounce in March 2025 and has continued climbing past $4,000 by late 2025. It is not retail excitement. It is the largest institutional accumulation of gold in modern history. The fourth condition is not just present. It is more pronounced, more coordinated, and more openly discussed than at any point in the past century. Now let me be completely honest about what this framework tells you and what it does not. It does not tell you timing. The 1970s gold run took 9 years and included a brutal 47% drawdown from 1974 to 1976, right in the middle of the greatest bull market of that century. Investors who panicked and sold during that drawdown missed the move from $110 to $850. Investors who understood the structural picture held through the pain and captured the entire run. That is the single most important practical lesson from 100 years of monetary history. When genuine structural forces are driving a move, volatility is not a signal to exit. It is a signal to ensure your position is sized properly, so that volatility does not force you out at the worst possible moment. Position sizing is not glamorous. It does not generate excitement, but it is the single factor that separates investors who identify a trend correctly and profit from it, from those who identify it correctly and still lose money because they could not hold through the chop. The framework for precious metals allocation is not a fixed percentage. It scales with structural signal strength. How many of the four conditions are present? How developed is each one? What is the institutional evidence telling us? When all four conditions are present simultaneously, as they are right now, the case for a meaningful structural allocation to gold and silver, not a speculative trade, but a considered diversified position, is as strong as it has been at any point in modern monetary history. Here's what usually happens. The people who understand these structural conditions early, who position themselves thoughtfully, and who have the discipline to hold through volatility, are the ones who look back 5 years later and understand why this moment mattered. The people staring at daily price charts, reacting to every swing, buying at peaks of excitement, and panic selling at troughs of fear, are the ones who, as the historical record shows again and again, do exactly the opposite of what the structure was telling them to do. The four conditions are present. They have preceded every major gold move of the past century. Understanding them is not a guarantee of the future, but it is the most honest and rigorous basis to think about where the monetary system is heading and which assets are structurally positioned to preserve real purchasing power through what comes next. The signals are on the table. What you do with them is entirely up to you.